Losing a spouse can be one of the most difficult experiences that a person will ever go through. But if one loses their mate in retirement, one has to deal with, in addition to the grief of losing their best friend, they have to deal with financial consequences. They have to likely deal with a lower income. And because of the way the tax code is set up, a person could end up giving more money to the tax man, even though their income has been reduced. This tricky tax is called the widow's tax penalty. In this video, we're going to explain what that penalty is, how it applies to one's retirement, and some steps that a person can take to avoid it. Hello, my name is Jason Kennedy. I am the founder of the Kennedy Financial Group, as well as the founder for the Chicago Alliance for Medical Professionals and Educators. For more than the past decade, we have been working with educators and medical professionals to help them increase their retirement income by at least 42% by helping them add tax-free assets to their retirement plan. If you've been following us for a while, we ask that you please subscribe. We'd love to be able to make sure that you're notified each time we produce a new video. And if you like this video, by the end of it, give us a like. Let us know in the comments. Show us some love. We'd appreciate that. Now, in order to understand how this particular tax penalty works, we do need to understand just a little bit about taxes. For example, a married person is treated differently in the tax code than a single person. Okay, so let's say we have a married couple. They make $80,000 a year. Do you see what tax bracket they'll fall into? You see at that $80,000 a year, they'll fall into a 12% tax bracket. But if one mate dies, what happens to that same level of income? Well, it's taxed at a higher rate. As you can see, it's taxed at a 22% tax bracket. And so this can be problematic for a surviving spouse because unless they're willing to push their income all the way down to below 40,000, they're going to be in a situation where their tax bracket will be higher than it was for the period of their retirement where they were with their surviving spouse. Now, the second way that the tax code treats a widow or widower differently has to do with the standard deduction. If a person files their taxes in a joint manner, at the end of the year, the IRS allows them to deduct $25,000 from their income. So if I made $100,000, I'm able to subtract $25,000 from that, and I'm taxed as if I made $75,000. But when a person loses their mate, what happens to that standard deduction? Well, that standard deduction goes down to $12,000, and the amount of their income that is taxable goes up. So let's just recap what we got so far. When a mate passes away, their tax bracket can change, going up, and their standard deduction can go down. The combination of both of these things could put that widow in a situation where they're paying more tax than they were before. Let's walk through an example. So imagine for a second, we have a couple. They make $100,000 together a year. Now they're in retirement, so some of that is coming from Social Security. Some of that is coming from their pension or their IRA withdrawals. When the IRS does the calculation to determine how much of this $100,000 is taxable, they come up with $87,000. And the reason why is because not all of their Social Security income is taxable. The most that can be taxed is 85%. So they do their calculation. They determine 87,000 is taxable. They subtract the standard deduction, which is 25,000. The total amount of income that this couple will owe taxes on is 62,000. So they'll have a tax bill each year of $77,105. So that's what they'll pay each year now that they're married. But what happens when the mate passes away? So if one mate passes away, their income is not necessarily going to cut in half. They still live in the same house. They still pay the same utilities. Some things would go down, maybe groceries, maybe traveling, but a lot of things will stay the same. And so if the income drops, let's say by 20%, they go from 100,000 to 80,000, they lose Social Security, they reduce the amount of money they're taking from their IRA. When the IRS does the calculation, their adjusted gross income is 75,000, but their standard deduction is lower. See, the standard deduction is lower. It's 12,500. So their taxable income is actually more when they're single than it was when they were married. On top of that, because they're being taxed as a single person now, they have to pay a higher tax rate on that income than they would if they were still married. So their taxes jump up in retirement to $9,558. So even though they have less income, they're withdrawing less from their IRA, they have less Social Security, they have to pay more money in taxes because of the way that the tax code works. And so, what are some things that a person, a couple could do right now to eliminate the risk that this tax penalty can hold? Well, let's just highlight three things that can be done. The first one is to use a Roth IRA. See, if Jack and Jill had been saving money in a Roth IRA this entire time, and if they would have done tax smart Roth conversions, slowly converting their money to a Roth position before Jack died, then when Jack passed away, Jill would have been able to access money as she needed it without an increase in her taxable income at all. In fact, her tax rate likely would have gone down because she would have only been drawing money from her Roth assets. The second solution to this problem is to use a life insurance policy. Many couples have put life insurance in place just for this purpose. The way it would work is when Jack passes away, a death benefit pays out to Jill to either cover some of that increased tax burden or to give her another source of income that she can use to offset some of the changes that are happening in her situation. And the third solution to this problem is to use life insurance to build up cash that can be used. Uh, Life insurance, when designed the right way, meaning you squash the death benefit down and put in as much extra cash as you can, it can be used just like a Roth IRA, except there's no market risk associated with it. But nonetheless, you could use those funds to create income for yourself in retirement. The bottom line of this whole discussion is that this widow's tax trap is something that can certainly sneak up on a couple. They may not even be aware of it until one of the mates pass away. But knowing about it in advance allows us to plan out a strategy to diversify, not have everything in a tax deferred position, have some tax free money, so that by the time you get to retirement, you can control to a certain extent the amount of taxes that you pay. Once again, my name is Jason Kennedy. If you appreciated this video, give us a like, subscribe to the channel, let us know. And as always, if you want help converting assets to a tax-free position, if you're looking to stockpile money that is non-taxable in retirement, I'm happy to help you do that. Feel free to reach out with the contact information below. Until the next time we meet, take care.